Good morning, everybody. I think a few more people are coming on board and we'll let them do that. But otherwise, I'll just start my own introductions. Danny Thorniley, President of the CEE Russia Business Group, and a warm welcome to all of you. It's a sort of a midsummer catch-up. Some of you have heard my remarks many times, and pleasure to be sharing them again today. I would like to remind all of you that I'm doing full, intense, focused, in-house private webinars almost every day on CEE and Russia, on specific markets within there, just Russia focused, on your industrial sector and so on. I enjoy it very much. So please, especially with the budget period coming up now, please use that facility, contact us, and I'll be very pleased to do it with you and your management team or all your colleagues or whatever. Quite a challenge today for me to do all of CEE and Russia in about 45, 50 minutes. And it's going to be a little bit all over the place intentionally. And I want to give you a feel, and I want to touch on some key business dynamics. First of all, sorry, I'm jumping around. I had a conversation yesterday with an automotive supplier, very big one for Russia and Central Europe. And he said, surprisingly for automotive for me, or half surprisingly, 2020 was a golden year for us in Russia and a very good year in Central Europe. January, March of 2020 was very good. April, June, catastrophe. July, bad. August, so-so, and then picked up very strong indeed. And that's continued through 2021. He expects a strong first half to 2022 next year, and then a softening in the second half of the year. And I'll come back to that in my own analysis. He even went so far as to say, we find it difficult to meet demand, and we are in such a strong position, we can choose our own customers and the segments we want to play in. His staff in Russia, he points out, I'm just touching on general themes now, can handle a crisis very well. And we know this cliche, Russians have had 100 years of crisis, so they can manage crises quite well. On Central Europe, one of our consumer products companies said, our team have been growing so well pre-COVID for 7 years that they were less adept at handling a crisis like this, but they did adapt very well to it. The automotive company I talk about, interestingly, and I'll come back to it later, polarization of the market. Cheap, affordable, low price products are doing very well, and premium, super premium are also doing well in this automotive and automotive supply section. He also raised the question with me, he said, Danny, what's the perception of inflation in Russia and Central Europe? And I'll come back to that shortly, because inflation, consumer price inflation and producer price inflation coming into your companies is, of course, one of the big themes this year. And I want also to provide some reasonably good news for you on that topic in the medium term. Just a quick word on the global environment that we have. This is going to be a good year. We're in the middle of a boom. We've got supply shortages, semiconductor shortages, rising inflation because of input costs and demand. Inflation is rising because growth is fast and strong. This is the trade-off. This year, China will grow at 8%, the US at 6 to 7%. This is very strong indeed. Oil price will be 65, 70, 72 for Brent. The stock markets will continue their sometimes pornographic surge and so on. However, next year, China not 8 to only 5%, and the United States 7 to 3.5. I do not see a global crash next year, but from the spring or summer next year, we're going to see a normalization, a moderation of business globally and within Central Europe and Russia. So important for your business and budget planning, I think. That would impact maybe 80% of all companies doing business. So no crash, but a moderation of business for sure. In Central Europe and Russia, we will have a moderation as well. However, in comparison with other regions, Latin America, Africa, Middle East, Asia, and I'm sorry, you've heard me say this 1,000 times, Russia, Central Europe will be performing relatively better this year, last year, next year, and until 2030. This is my strong opinion, macroeconomically and from a business perspective. I've only had a handful of business trips so far, although I'm pleased to say end of next week I fly back to Russia, but I have had 300, 400 webinars and so forth, and 280 executives have told me, including yesterday and the day before yesterday, that Central Europe and Russia are among the best performing market in the world for their company, or in the top 2, very strong. You can include Russia or exclude Russia in this equation as you wish. That's the very quick global feel and summary. One sad comment, and there are several risks out there, but one of them, we seem to be able to manage geopolitical risk. Domestic politics, China, external, very tense, but business is going strong. Russia, politics, questionable, but business good and strong for many. But in the United States of America, the politics are extremely frightening. And that's not a phrase I use very often. However, business in America, the dollar is strong, the stock markets are booming, the IT companies are world beaters, and so on. But the political outlook for the United States is extremely disturbing. 45 million Americans believe that Trump is the legitimate president of the United States of America, and 45 million think that the attack on the Congress on the 6th of January was legitimate. By the way, 21% of the adult population in the United States of America is functionally illiterate. That's 43%, 21%. In Russia, that would be 1.2%. In Central Europe, 1%. In Britain, 1.2%, and so on. Food for thought. Just want to share something with you, which I came across recently. It's a theme I've been following. I'm jumping around as I promised I would. Employment in small, medium-sized enterprises. In urban China, this is 80%. In Germany, it's 58%. In the US, it's 50%. In Central Europe, it's 40% plus. And in Russia, it's 27%. And that's an indication of the strength of the small, medium-sized enterprise sector, of course, or its weakness. And it shows how the function of the Russian economy is very state-orientated. I do apologize, I'm really jumping around intentionally though. Digitalization, e-commerce is and will be a big driver for your businesses for the next forever, and certainly in your next budget planning. And oh my God, you know, you've got enough problems with budgets, but do you have to do 2 budgets? One for traditional business, one for e-commerce business. Actually, I imagine you can amalgamate them or divide them in 2 somehow. But e-commerce for Central Europe and Russia, for companies and as a part of the economy, the proportion of retail sales, e-commerce, was on average for our region, total region, 3 to 5% pre-COVID. At the height of the COVID crisis last spring, 12 to 15%, and then came down as there was opening up and unlocking to 8, 10%. So 4 to 5 to 13 to 15 to 8 to 10. So an effective doubling almost of e-commerce. And while your traditional business will grow in good single digits in most of the markets of this region, e-commerce, of course, will be high double digits. One of our companies in Russia, in public on one of our webinars, said, Danny, we've grown e-commerce last year by 150%. We did in 1 year what we planned in 3 years or planned in 5 years. There won't be, for many companies, 150% growth continuing annually, but it will be good double-digit growth. Another feature of e-commerce, of course, is the profitability for many, not all. One of the downsides is price transparency, and I'll come to that. But a company, it's public information, but I want to be courteous, a company that provides household consumer goods globally, premium pricing in Russia, including hair dryers is one of their products. You may guess who they are. They sell hair dryers for 200, 300, 400 euros a time and do well in Russia. Their profitability increased massively. Growth and sales were strong double digits, but the e-commerce element allowed their company to increase profitability by extraordinary double digits. The automotive company I was talking about yesterday also has a developing digital e-commerce business, and this executive mentioned just yesterday the increased profitability on that. So this will be a driver and a shaker and something you have to manage and handle going forward. One of the challenges, and I hope, and we're not medical doctors, I don't believe on this call, but can COVID hijack the economic business recovery? I think and hope that each wave, the third, fourth wave that Russia's going through, probably the fourth wave that all of Europe and the world will go through in the winter, will be manageable enough. We won't probably have any more national lockdowns. Manufacturing has been not so badly hit anyway and will not be, but it's difficult to see extensive national lockdowns on the consumer side in the future as the vaccination kicks in. But it could be a moderate mid-scale risk moving forward. Just some sober, not good news for us all. Fatalities per capita from COVID, as of today, in the top 10 worst countries of the world, per capita deaths, 8 are in our region. And they include, from the top, Hungary, Bosnia, Czech, Bulgaria, Macedonia, Montenegro. And in the top 20 worst fatalities per head are included Slovenia, Croatia, Poland, and Romania. So very disturbing news, but the economies have opened up and business continues. Russia is something specific, of course. Until the start of this year, Russia was maybe 10, 12% vaccinated. There's been a massive public program. Our friends from Russia on the call know this, and this has probably taken the national average to 20, 25% plus. Companies have been burdened with doing this, getting it to 60% by the summer. And this has been a challenge. One company told me this week, Danny, we're at 50% vaccination, but my God, it's cost blood, sweat, tears, and money to achieve that, to convince our Russian staff about the vaccination levels. Vaccinations, the level will be key to the impact going forward. Sadly, I think we're going to have to live and manage COVID for many more years to come, perhaps with annual inoculations and vaccinations, and it might be like the regular influenza virus that we have every year. I hope it's like the Spanish flu, not in the sense of killing tens of millions of people, but of going away one day. But that was after 3 or 4 years, so bear that in mind. One final point on the COVID. At the start of July, Britain had 25,000 new cases per day. Russia had 25,000 new cases per day at the start of July. British mortality, fatalities per day was 20, Russia was 800. This is the impact of vaccinations. Britain is 68, 70% vaccinated last month. Russia was 12, 15%. I don't want to get into COVID politics, so I'll move on. Move on to something very different. ESG, environment, social governance. We had a special webinar just last week, so I'm well informed, but really just a snippet for you. Is it burning, an operational issue that affects your business daily? No. 30% of our clients for Central Europe and Russia say it's important. 30% say it will be important soon, within the next 2 to 4 year time frame, and 30% are saying it's not important and it's not a key factor for them at the moment. More than 50% of companies do say, of course, it is something that is rising and important and critical for their business. I come to my little truisms and cliches about business. I always like to mention them, and I'm happy to discuss this in conversations at the end. Diversification, localization, digitalization, market share. I'll come back to market share because that's part of the competitive environment we're in. Digitalization, I've given a snapshot. Localization, companies, yes, are going back onshore to their home countries, not so much as we would think, but they're looking about in a more protective world. We maybe want to be less global and therefore more local or regional in certain sectors and territories. And that could include Russia. Let's be more local in Russia. Let's put all our risks within Russia and worry less about global impacts moving forward. It's not a major dynamic, but it is happening a little bit. Supply chains, by the way, the view 15 months ago, we will close all our supply chains with China and put them in Moldova or Romania, did not happen. Very much not so. Yes, some US companies, yes, some medical supplies and so forth, but broadly, the supply chain from China has been little changed, and big investments going from the West and from the United States of America very much into the financial sector of China, although there is massive tension between the two, which will remain for the next decade or longer. On the ground, operational and financial business is continuing, and supply chains have not been so badly hit yet. Just coming to a quick summary, I finished my introduction, a little behind time. Overall, I would suggest to you that for 2020, many survived the year well and a lot better than they expected in the spring of 2020. Some did very well indeed. Home consumption, kitchens, home food deliveries and so forth. This did very well. Household durables, household IT and so forth. These were very strong. Medical and health generally did very well indeed, globally and in our region. The consumer product sector, which I will come to shortly, good or not, depending on the subsector, and this polarization and tremendous price pressures. What's interesting on the business-to-business industrial side is that this was hit pre-COVID, and you wondered where the money was coming from, but we've seen a strong and good recovery in Russia and in Central Europe, and we're going to see a big recovery in Central Europe coming up. Just on B2B, first of all, Russia industrial investment was wobbling, not enough investment from the government, the private sector not confident about investing at home, and that still remains. The government did not put enough money into small, medium-sized enterprises and mid-sized companies in Russia. Gazprom, Lukoil, VTB Bank, they got funding big time, etc. But there was an emphasis on the big parastate companies within that. Trade went down, confidence went down, supplies were struggling. However, what we've seen now in this year, broadly most of it for Russia and Central Europe, the automotive industry has rallied and recovered. It's still got some big challenges, but it's much better than expected. Oil and gas, the price of oil at $70 a barrel for Brent. OPEC plus agreements allowing countries to produce more, which will help all the commodity countries and helps Russia. Global trade was down 10% last year, is up 10% plus this year. And Russia, of course, commodity price markets, metals, minings, and other so forth, those kind of industrial products, commodity products, massive growth in the markets, helping a boom for Russian exports, the current account, the trade surplus, and confidence on that. So more money coming back into the energy sector as well. And when Gazprom does well, Russia usually does well because it's got 100,000 suppliers, followed by another 100,000 sub-suppliers who are all pushing the industrial product and related supplies into the Russian economy. And this is happening. So we're seeing a pickup there. A pickup in industrial product, but still don't forget, domestic investment is so la la. They're looking at bringing money from the Sovereign Wealth Fund, which could be a positive, but a negative is foreign direct investment in Russia, which is extremely weak, officially, of course. Energy sector, financial sector, sanctions, and so on. But as you know, and I know, operationally on the ground, companies are doing well. And low-key reinvestment is definitely going on in Russia, the warehousing sector, logistics, and so forth. One of our group members is opening a plant in the food industry and a mill in Russia this year. Many companies opened up their own stores and retail outlets, branded retail outlets in Moscow last year, and continue to do so. So that was just a very quick synopsis overview of some of the sectors, and I'll be very happy to answer questions at the end on any sector. For example, I've not done justice to the pharmaceutical medical sector there. I did a full presentation for one company yesterday, so I'm actually overflowing with thoughts and ideas on that sector. So please ask me, and please ask me to come in-house to do it for you as well. Still just some snapshots, and then I'm going into the core of the presentation. A supplier into the Russian construction industry 6 weeks ago said to me, Danny, I wish this boom in business would stop. She's growing her business 30% plus top line, but her customers, the construction companies, the property companies, are saying, look, prices for everything are booming. You need to fix the price that you sell to us. If it goes up afterwards, that's your problem and you have to pay for it. The executive was complaining, I'm like a hedge fund manager. It's crazy. My timber prices went up 3 times in March. By the way, timber has come down a lot since March, and so on and so on. Some of her customers were saying, look, this is so hectic and so tumultuous. We want to take a time out, a pérérive. We don't want to buy anything for 2, 3, 4 weeks. Let's just see what happens with the market. We want to build new apartments. By the way, the housing residential sector is booming globally across Central Europe in all your markets and in Russia. Mortgages last year and currently are growing at 25 to 50%, depending on contracts or value. The price of property in Moscow is up 22, 24% in the last 12 months, as it is in the United States of America, by the way, as it is in the United Kingdom. So this construction, real estate, residential boom we're seeing globally because of savings ratios and people wanting to park their money and invest their money. So that's the construction sector globally. It's very hot. I think, by the way, in Russia, you know that the amount of subsidy and the interest rate has changed to moderate that boom a little bit. One of our, by the way, when you're planning your budgets, which is, we're almost coming to the budget season, sadly, for January 2022, one executive famously said to me, said, Danny, I've made 20 budgets for Russia and they were all wrong. He then joked, he said, I got the trends right. I got the trends right. What we're seeing also in Russia and in Central Europe, I'll give the figures now. I've said good growth, good markets. What does that mean? In Central Europe, it means for FMCGs, 2, 3, 4, 5%, which is almost like Western Europe, but better than Western Europe, which is 1, 2, 3. And a lot of B2B and pharma companies in Central Europe are looking at steady single digits. 65 to 75% of our group members are looking for single digit growth this year and certainly next year in Central Europe. The others, 10 to 15%, are looking at double digits, which is 10 to 13%. Organic, top line, local currency, sales growth. And by the way, 10 to 12% of our clientele expect flat negative sales this year, next year. That varies. It's not the same companies. It depends on maybe they're restructuring, they're in the wrong place at the wrong time, they have the wrong business model. Not everybody is happy. Please don't get it wrong, of course, that everybody is in happy days. Not all, but relatively, these are strong numbers indeed. For Russia, more volatility, more risk, and more return. And by the way, one of our companies for Russia said, Danny, our return on investment has been stronger in Russia for the last 20 years than anywhere else in the world, stronger than even Central Europe. Yes, it's trending down as a percentage, but it is still strong. So Russia, glibly, higher risk and possibility of higher returns as well. But certainly one company, Bread and Chocolate, said recently in public, it said, Danny, in 2021 and planning for 2022, I can grow top line in Russia 8-9%, which fits in with a kind of thing, single digits, good single digits for Russia, for many, 2/3, 70% also. But this executive went on to say that my problem is my headquarters want 13 to 14%. So 8-9 to 13%. And he said, I need more investment for that. Now, the good news for this company, it's a European company. It's been in the Russian Soviet market for years. They have a manufacturing plant. This executive will discuss with his board and they will find a good working compromise for investment in Russia moving forward. Pricing, inflation, and so forth. Now I'm coming into a sensitive area indeed. One of the executives this week said to me, Danny, I think I mentioned it at the start, he said, Danny, please explain the emotions and the perceptions of inflation. Let me give it to you. We're in a boom. There's a mismatch in supply and demand. There's exuberance, there's revenge spending, there's high savings ratios. People are coming out and spending. Commodity prices are rising. Food prices, wheat, grain, rice were rising. This is feeding in to the consumer price inflation as well. I think it's manageable, and I don't think it merits extreme stress and strain, although I am well aware that obviously companies have to pay for those higher costs, and they cannot usually compensate entirely for that cost with increased prices, and therefore there is definitely pressure on margins. I do not negate that, and companies are looking at that and reassessing everything related around it. However, when you look at the inflation numbers for, East Central Europe, you're looking this year at, I'm just looking at the numbers for you. I know the numbers 2.5 to 4.5. That's very much the case. Romania 3.7 this year. This is the average inflation figure. Poland average this year will be 4.1. Of course, at the moment, we're at the peak of the inflationary cycle. These are average numbers, but Estonia 2.4, Czech Republic 3. These are not 6, 7, 8, 10, 12, not yet, and I don't think they will get that route. The consensus view by me, by all the central banks in all your markets, by the IMF, by the World Bank, is that top line inflation will trend downwards and producer price inflation will trend downwards next year. This is the consensus. Let's just take Russia as an example now. Russia inflation last month, 6.5%. Russia is more volatile, of course. 6.5%. The Russian central bank is professional, it's doing its job, and it's raised interest rates to 6.5%. I think they'll go to a maximum of 7% interest rates. But the consensus view is that will trend down. At the end of the year, it will be 5.7, 5.8. But average inflation in Russia this year will probably be 5.8 to 6% average this year. This Russian central bank thinks it will be 4.5 plus next year, and I do not disagree with them. However, the perception of inflation in Russia today is not 5, 6, it's 13.5. And that mismatch between inflation and the perception from the consumer is in Britain, the United States, Germany, Switzerland, and everywhere else. I'm sorry, this is how inflation works and is perceived. The Russian Statistical Authority, Rosstat, collects inflation from a basket of goods. That doesn't include house prices. It includes rental of housing and property. And that's a typical, by the way, mismatch in the inflation package. Some of its indicators and costs are flat, low, but most consumers will say the products I buy are rising 8, 10, 15%. And it's a similar emotional discussion in other markets as well. Rosstat is a professional organization as well, and it's as good as the French, German, American statistical authorities and collection for inflation figures. One thing about Russia also, and other countries as well, if top line national consumer price inflation is 6.5, then in Moscow it's not 6.5, it's 10, 11, 11.5. And this, of course, has an impact on perceptions of your staff. Many of them, most of them working in Moscow, and you will be telling them last year, this year, next year, we're using national inflation from Rosstat as our benchmark for salary increases. And they will say, well, Moscow is more expensive, but actually we do know, we do have to say that most companies, the bedrock is the national consumer price inflation. One thing to watch out for, which will be emotional as well, I think it's fair for companies to predict and say that inflation next year in Russia and your other markets will be lower than today and lower than at the end of this year and lower than when you're making your budgets now in the autumn. So you'll be making budgets for salary increases perhaps of 4 to 5% in Russia next year. And if you're using a prediction for inflation, or 2 to 3 for some of the Central European markets, if your staff find that out, they will be very disgruntled because they'll be saying all the things I've just said. So managing expectations on the future average inflation is a challenging discussion. You know this, we've been through it before, and so forth. This impacts the inflation story on price increases and what's happening to them. Broadly, in Central Europe and Russia in recent years, you've been very conservative on price increases. The ruble and the other currencies were rock solid stable. Inflation was, pre-COVID, low or very low. The retailers, the suppliers didn't want to take on big price increases. We've got promotions and discounts anyway. So you were looking at 2, 3, 4% price increases. All our surveys and anecdotes show that this has been pushed up. Prices from your companies are not rising like this, but they are rising and tweaking up. So if an average for Central Europe was 2 to 5%, now it's 4 to 6.5%. And in Russia, if the average was 4 to 7%, that's tweaked up to 6 to 9 to 10%. In Russia, we have a handful of companies who are saying we're going to put up our prices by 8 to 12% next year. That is a minority. By the way, just coming back to the producer prices, producer input costs in several markets in Central Europe now are rising 10% at 25-year highs, but Slovakia is only rising 3-4%. Russia, Turkey, Ukraine, last month, input costs, food included, were rising plus 33%. Russia, Turkey, Ukraine, where there's more volatility with the exchange rate and where the logistics transport has bigger demands on it. But we think, as you've heard me say, the mismatch will be balanced out, demand will be self-managing, and the base effect from last year's lows will come out of the equation as well. One of our food and beverage companies in Russia with big investment has said, Danny, in my budget for 2022, I'm planning for increased producer costs of 10 to 12%. I think that's very interesting. He may want to modify that as we go forward in the budget as he's doing it. But remember, those costs are rising at 33% this month or last month. And he thinks, and I agree with him, it will trend down. So pick a number below 30% for your average for next year. I gave a little bit of time to that because it's very emotive and very important. Just want now to look at exchange rate costs, of course. Oh my God, I've hardly done anything. Exchange rate costs and threats moving forward. Central Europe, we had the pickup in FX rates in March last year. Then, as we predicted strongly, we saw stabilization. For your FX rates in Central Europe next year, I think also stability. I think the Czech crown will strengthen 2 to 3, 4% next year. The zloty will be stable or strengthen. The foreign will be stable but wobbling. And the Romanian leu, which is always going to crash, never crashes, and also will be stable with maybe 1-2% depreciation. So really fairly solid. I see the dollar euro at 117, 118, and at the moment it's 118, 119. Before I come to the ruble, one thing about and this is the lead into the ruble, my outlook is steady and upbeat. Upbeat's not the right word for the ruble, but I'll come to that in a moment. But one risk for all your currencies vis-a-vis the dollar and the ruble dollar is rising US interest rates. The Federal Reserve said 3-4 weeks ago, one day we may think about vaguely raising interest rates a little bit quicker than we're thinking at the moment, which is not very much indeed. The markets panicked. All emerging market currencies weakened against the dollar, including the ruble by 2-3 rubles in a couple of days, and now it's placated. We will see the Federal Reserve probably accelerate. And remember, US interest rates are close to zero, but they'll get closer to normalization over the next 2 or 3 years, as other countries will do, as Central Europe will do. But we got this dollar rising potential and discussion for the next 1 or 2 years. I don't think it's a big threat, but it's there. With the Russian ruble, we're at 72 yesterday to the dollar and 87.5 to the euro. We've argued for a long time it would be in that range. Many of you budgeted for that kind of range last year. And I think from a macroeconomic point of view, I would suggest the ruble could be very close to these kind of numbers, 72 to 73 to the dollar and 87 to 88 to the euro. That's macroeconomically. If I was sitting in your shoes in Moscow, I'd be thinking, well, that's a nice macroeconomic analysis, but I'm a little bit more concerned about my position. I want some safety and I want some fat. So instead of 72.3 to the dollar, I might want to try and budget 74, 75. And for the euro, I'd like to try and budget 88, 89, 90. To be on the safe side. And by the way, in our recent survey, this was a majority consensus view of you, the executives, as well, this kind of ballpark. Very few, hardly any of you are thinking of 75 plus to the dollar next year or 90 plus to the euro. So that's the feel. Geopolitics have been the deciding factor and the professionalism of the Russian Central Bank. I talked before about GDP and industry. I've made some passing remarks on health, but let me talk about the consumer and some of the dynamics that face many of you on the call today in the consumer goods sector as well. Overall, consumer goods fit into our picture of single-digit growth and some of you looking at double digits. Let me stress again, and I've got the numbers in front of me, the thinking of moderation for next year. This year in Russia, for example, 37% of our group members, 37% plan double-digit growth in Russia. Of course, some of this is the bounce back. It could be based on 2020 figures or 2019 figures. This is a funny year for comparisons. But here's the point. 37 look at double digits this year, 20% next year. In pharma this year in Russia, validly, 40% look at double digits, but next year, only 23%. Same trend in industrials, not quite so strong. The point for Russia, and it applies already to Central Europe, next year, 63% of all companies are looking at single-digit growth. In consumer products, 73%. In pharma, 61%. So a good, solid, decent single-digit, high single-digit market is the outlook for Russia, and a good mid-single digit, single digits is the outlook for Central Europe for the majority of companies, with some upside for 20% of companies and some downside for 5 to 10% of companies. And as I say, what's dictating the consumer sector, of course, is which sector are you in? The general FMCG companies have survived in single-digit growth. Anything that's to do with health or safety or wellness has done well. Cosmetics have come back. Skincare is back in a very big way, and cosmetic companies have done very well out of that. I talked about home consumption. All our clients in consumer durables, consumer household furniture, anything that's used at home use, did extremely well, big double digits across the region in 2020, and is still doing sustainably well in 2021. Some executives were worried, saying, Danny, we've grown 50% in selling kitchens in Russia. It's great. They want to remont, they want to improve their Moscow flat and their dacha, and they have the money to do it this year. So 2020 was our boom year. But will we see a big bounce down in 2021? No, not yet. And generally, for the consumer for Central Europe and Russia, and several of you have heard this before, you got the questions of less foreign international tourism travel, which, by the way, is a negative for some of the Southeast countries, Croatia, Slovenia, those dependent on tourism and so on. But less foreign travel means more money at home spent in country. It can be for staycations, domestic holidays. It's often saved and it's spent on other consumer and service items. And that's what's happening. Savings ratios. People were forced, had to save. They didn't go out, especially in Central Europe, Western Europe, less so with the lockdowns in Russia. But however, even in Russia, there is self-isolation going on. In Russia, footfall, people visiting shops, footfall in Russia with no lockdowns for a year is still 10 to 14% less than pre-COVID. But because people have money, the convergence rate of people buying things when in the shop is higher. So shoppers are more serious. And also the basket, the size of the basket is bigger. They're buying more and spending more. You've got then other dynamics, which means they're not buying your chocolate or your soap. They are, as I've said, buying cars. Not quite the same level they were before, but they are doing so. And I've mentioned it already, the property, residential sector, they're buying flats and so on. By the way, generally in Central Europe and Russia, this polarization, the flats are in Russia, but in Prague as well. In Russia, 2, 3, 4, 5 million, 15, 20, 30, 40, $50,000. Or penthouses at $1 million. You've got the polarization in the housing market as well. You've got polarization in chocolate. You've got polarization in clothing or in drinks. And that, ladies and gentlemen, is because you have polarization in society. The rich are rich and stay rich and buy rich. The poor are poor and stay poor and buy poor. And we're seeing the affordability issue very much globally and across Central Europe and Russia. I've said many times, 80% of the group members talk about affordability and promotions and discounts. This is the killer for all of us. We know this in the consumer goods sector and in other sectors as well, the power of price and affordability. Promotions and discounts account for 50% of FMCG business, 60% of cosmetics, and 70-75% plus of alcohol drinks business. As one executive from the consumer goods sector for the whole of Central Europe, a diversified consumer products company said, how low can the Central European consumer go with price? And the feeling is also from one of the food companies for Russia and Central Europe, our customers, and they're a branded company, our customers are only interested in price. That is the single driver. Perhaps an exaggeration, but one of the themes there. Just want to share with you a funny comment from one executive who said to me recently. She said, Danny, B2B company, she said, Danny, like everybody, we're raising our prices. So we raise our prices in their business 8, 10, 12%. But then somebody wants discount, so we discount it. And then she said, I know my friends in consumer goods, they raise their prices and have promotions and discounts. She called this dynamic monkey money. I think it was just a personal phrase she used. We know how it works, but I think it was a nice little snapshot to call it monkey money for the consumer there. I'm looking at my time, it's 48 minutes. Even I think this was a strange presentation. It was a little bit, I did say at the start that it would be all over the place, schematic. I think that was unavoidable, so such a big geography. Russia and Central Europe are very similar and are very dissimilar. And I've tried to capture some of those common trends and features. Just as I close off though, one point on the consumer and the general economy as well. Wages and unemployment globally have performed better than we could have expected. In Central Europe, before COVID, unemployment was very low and real wages after inflation were very high. And they stayed steady and strong in Central Europe and in Russia. In all the key Central European and Russian markets, real wages stayed positive after inflation. This was shocking to me. I expected some downturn. In Russia, real wages, except for April last year, every month was positive. The average last year for Russia for real wages after inflation was about 2%. This year, we're looking at also similarly 2%, and probably next year, 2 to 5%. What I'm saying is, if this year average inflation is going to be 5.8, that means if real wages are 2, it's 5.8 plus 2. So nominal wages as an average, the average wage that the Russians get this year, and it's only an average, would be 7.8 to 8%. Some months it changes on bonuses, special payments, and generally, by the way, ladies and gentlemen, the public sector in Russia for wages on average every month has been much stronger than the private sector. This is within the economy. We're seeing some catch up a little bit with bonuses. The private sector is being pushed to pay more on the salary front, as I said. I've got so many postscripts that I want to tag on there, but I'll be speaking for another hour if I do that. Please let me remind you, I can do a much more focused presentation for you anytime you want, and please let me know. And now with your help, Andrea, I'm going to go to the Q&A and chat and the Q&A. Thank you. What are the fundamental reasons for the current boom supply-demand mismatch? Is there a connection to internal Chinese market? Thank you. Great question. The mismatch, as I say, is surprisingly, I think so many companies, suppliers, shippers, logistical companies, didn't anticipate the current boom we're in. And I don't like to be critical, but you know, it should have been anticipated. It was not difficult to see that we're going to get some kind of post-COVID boom. Could be impacted by more waves of COVID, who knows, whatever, but you think it would be expected. The summer boom in the Northern Hemisphere was expected. From January, we saw that Biden was pushing trillions of dollars into the US economy for growth, consumption, and it was all there. We saw China was still growing and so on, and to your question. So it should have been, I think, better anticipated and wasn't. And I think companies now will quickly try and get supply and demand. And the history of global business and trade is that mismatches are usually reasonably quickly sorted out. So I'm thinking certainly by the turn of the year, this will be rectified in large part. Yes, of course, you've got more localization, more internal demand in China. You don't have 30 million Chinese in Oxford or Oxford Street or Paris, Milan or Moscow. And they are buying in China, which of course, to your question, it means more supply directed at the domestic Chinese market. But then, of course, you've got specifics, as you know, I'm sure from your question, the semiconductors from Taiwan. And Taiwan is not officially part of China, although the president of China is contemplating that one. Sorry, I'll get off that topic, which is a very touchy one indeed. So you've got those mismatches, very specific, and semiconductors. And semiconductors, of course, I talked about automotive recovering, and it is for sure. And it would be even better if the supply chain of semiconductors, so important to automotive, was operating fully, but it's not. So thank you for that. I repeat, the mismatch should be resolved, and you are right. Higher domestic demand in China tends to be one of the explanations. Is wealth distribution changing given the polarization trend in Russia? You said the rich are becoming richer. Where are they making most of their money? Thank you. Yes, it was a glib remark, maybe a bit too quick on that, but certainly the essence is correct. But actually, the rich are getting richer. I shouldn't qualify my qualification. The rich are getting richer. And in the United States of America, wait for it, personal wealth in 2020, I cannot remember the number, it's a crazy number, rose, I think, by $20 trillion. Let's say I'm wrong and it's only $10 trillion. So that's the United States of America. It's the same dynamic in Russia, and there tend to be globally, and in the last 10 years, when we've had quantitative easing, you've had lower interest rates, which until recently we had in Russia. And lower interest rates tends to mean when money is low interest rates and money is given by the government, subsidization and so forth, the rich benefit through income wages, but especially from two channels, the stock market, funds, and property. And property I've talked about. So, you know, if you bought a penthouse on Tverskaya 18 months ago, you've seen an appreciation 18 months ago, 30%. So let's say you bought it for $1 million. That sounds cheap. $1 million for your penthouse, and it's worth 1.3 million now. So, you know, that's the no-brainer. We are seeing in Russia a 500% increase in personal investment in the stock markets, including legally foreign denominated stock markets as well, dollar, euros, yen ones. So rich people are investing in the stock markets, and also you're getting some day traders as well. In the United States, a massive amount of day traders going into that. And that's a reflection of, you know, the rich being able to use those channels. Stock markets, it tends to be rich people who invest in them, and or buying in commodity or gold, those who invest in gold after a 12-year drought saw an improvement and so forth. So I think that would be my explanation on that. And unfortunately, the big social differentiation and inequality are in China, the United States of America, and Russia must be in the top. It's in the top 10, but it's certainly probably in the top 5 or top 7 as well. And that dynamic, unfortunately, existed pre-COVID, and COVID, after a 2-3 month shock system, has only been exacerbated. Thank you. A moderation of growth. Right, thank you. Average forecasted growth for second half of 2022. That's a tricky one. And I'll get back to you, Eddie, on that, on the second half, because I can do the full year. And what I talked about Central Europe being relatively good, and my God, it is. On that, I talked about industry and investment and so on. And in Central Europe, the big dynamic is the EU funding. And I'm sorry, I apologize. I should have mentioned this much more in my presentation. Business to business, IT, industrial are and will 22, 23, 24 benefit very strongly from the new generation fund, the PPF funds that go into East Central Europe. These will be massive. The investment growth numbers for this year are already 4, 5, 6% average annual growth investment 2021. In 2022, for the EU CE markets, we see investment rising at 7, 8, 9, 10%. By the way, Ukraine, Turkey, and Russia, not members of the EU, good investment growth next year, but 4, 5%, not 6, 7, 8, 9, 10%. Now, some of this EU funding, by the way, will be regular budget and special new generation fund budget, and it's got a very big impact on potential growth. The growth figures for GDP this year have already been upgraded for Central Europe, again, which fits my story. Hungary this year, 2021, consensus growth, 6.3%. Even I, the optimist, think that's a bit strong, but let's say 6. Romania, closer to 7 than 6. Poland, almost 5%, the consensus growth number. And as I said, while Romania comes down from 7 to 4.5, Poland stays close to 5% next year. Hungary trends from 6 to 5%, while Czech Republic, which is softer this year with Slovakia, maybe the automotive sector not booming as much as it could be with supply problems, Czech and Slovakia actually rise next year. So my whole point about Central Europe being relatively stronger than other parts of the world is true. China, 8 to 5, US 7 to 3.5. These are clear numbers. And the European Union trending downward as well. So Central Europe, you know, I said it will moderate. It won't accelerate next year, that's for sure. And I would say something like, I'm trying to answer your question. If, you know, first half growth next year is averaging 4 to 5, then second half growth would be 2 to 3. So I just see a trend down, because when China booms, Germany booms. When Germany booms, Central Europe booms. And China's going to slow down, not collapse. But I think that impact is inevitable. We'll see it in trade. We'll see it perhaps in the automotive industry, direct sales to China, sub-supplies to Germany, to China. And I think that will moderate. So I would say something like second half of the year and final quarter of 2022 would be probably half the growth rates of the first half of the year. But that would still mean a good figure for the whole year. And back to Central Europe, which is special, the figures there would not be these 2 to 4s that I'm talking about for global growth. They'd be closer to 5%, which is remarkable. So perhaps I can qualify the story a little bit. Moderation of growth 2022, a little bit in 2022, and I'd push back the bigger moderation to 2023. Thanks for this question, because I can go on forever. The consensus view for 23 to 2030, I'm sorry, you know, yeah, what the hell. 23 to 30, the consensus view is for decent growth for Central Europe. Russian growth, less exciting, 1.5, 1.7, 1.8. Enough to support decent business. You can do decent business in Russia at those numbers, and you did so in 2016, 17, 18, and even 19. But Central Europe will be averaging 2 to 3.5% through 25 to 28. So again, if you're looking for a midterm business plan as well, I'm not whitewashing, I'm not, you know, jiggling up these numbers for you. I don't want to raise expectations idiotically. So that was the picture. Thanks a lot, and complicated answer to a good question. We saw an extreme price rise in metal and construction materials. Absolutely, thank you. Here's my point though. I'll take timber as one, and I've not looked at the timber price for a couple of hours, but in May, our annualized timber, lumber, global markets was up 300%. That was in May. In mid-July, not long ago, it was year on year 0. So massive spike, massive downturn on lumber, packaging, paper. But the price in July, I confess, was still 20, 40, 50% higher than 2 years ago. So, you know, we've had a massive surge to the spring of this year and then a come down. You're absolutely right. Metals and so forth are there. That's why the Russian mining industry is booming and so forth. But if I'm right, and really, I understand the complexities of this, I'm not being naive, oh, everything's going to be okay soon. It's not going to be quick. But I do think, for the reasons I've said before, supply and demand coming up, moderation, China, the US, and so on, the base effect coming up should mean that the average numbers come down. By the way, Russian producer prices in May were plus 35 and went down in June to 31. So, sorry, a little bit of decline. Could that be an indicator for the future? I stick with my estimate that we're going to see an improvement, moderation on input prices, certainly by the end of this year and during the fourth quarter, and certainly in Q1 of next year. Thank you. Thank you. I think inflation for us. Inflation in Russia, thank you. You just want a repetition, of course, Thomas, with pleasure. Yes, 6.5 last month, trending down to December. By December figure will be end of year 5.7, 5.8. This would give us an average for the year, because it started low, average this year of 5.8 to 6 average. Then for next year, for many, many reasons, the food, harvest, expectations, oil price, demand, all the things I talked about, I believe, the Russian central bank believes, the IMF, the World Bank, and the consensus view believes that average national inflation in Russia next year will be in a range of 4.5 to 5%. So I could certainly see 5%. I've got the consensus numbers in front of me, and consumer prices next year, end of 2022, so Christmas of next year, 4%, but that's the end of year. I think the average definitely 4.5 would be the lowest, and closer to 5% would be the highest average for next year. I'm going to the chat now. What is your expectation on labour market for blue collar workers? How much salary level may rise in 2022? From Anna. Thank you very much. Great question. I can give averages, but you know that blue collar workers globally and in Central Europe and in Poland, with less migration, obviously CIS to Russia, we have fewer migrants even now with transport blockages and people not wanting to move, but you have it in Poland, Ukrainians not coming into the country as well. So there's high demand. So you can get spikes in blue collar workers in certain countries and certain sectors at different times, 5, 10, 15, 20, 25%. I heard, and during last year and this year, in road construction, parts of construction, infrastructure, 15 to 20% was the going rate increase because the demand was so high and the supply relatively so low. However, if you're trying to make plans, budget expectations, and let's say stick with Russia, for white collar workers, if we're looking at a benchmark of national inflation, 4.5 to 5%, I said this before, which I think is reasonable. I think the Russian central bank knows what it's talking about, and that's my own assessment. Let's say 4.5 to 5%. For your white collar workers, that would be the benchmark you're using with a range and the averages and so forth. For blue collar workers, in our surveys, and I know the survey because I've looked at it yesterday, the trends on average are very similar. But, 5% this year and last year would be the budget and the expectation for blue collar workers. However, there is push on white collar and there is push And as I said, more spikes in blue collar because of these difficulties of getting people. One example, one of our food companies building a factory in Russia, public information. And the executive said, Danny, our costs for everything, metals and construction costs, are rising like crazy. Not the best time to build a factory anywhere, but it's going okay. Operatives on the production lines, blue collar workers. Normally, Danny, we can get a blue collar worker in a city in the regions in Russia in 1 day at the price we want. It's now taking us 2 months for operatives. This is not the managing director. This is not the head of marketing or so forth. So this is a challenge indeed. So my answer to your question is the average benchmark would be mid-single digits. I think we're seeing a pressure on salaries in Russia everywhere. We saw this last year. So if last year the average was 3.5 to 4.5, close to inflation, I had many companies saying we want to be at the top end of that for white collar and blue collar. So we'll push it up voluntarily. And this was before the market got so hot as it is now. So I'm sorry, I'm fumbling with this answer. The budget and expectation would be mid-single digit. I think this average pressure for a little bit more than that, so 5 to 6 to 7. And if you've got a project or you need this factory to keep running and there's big demand for the products you're producing or what you're building, and if the market rate is 8, 10, 12, you will pay that. That's the best I can do. Jonathan, thank you. What sectors are doing the best and the worst in 2021? Well, I can do that with great pleasure and go down through them. And it's not bad news. The best by far, no-brainer, was pharmaceuticals and medical, globally and in Russia. And in Russia, with the national projects still flowing through, this allows me to say a few words on pharma in Russia. Many of our big pharma companies selling to the Russian government now. It was difficult before the projects, national projects. So 15, 16, 17, 18, selling oncology, cardiology to the Russian government was hell. Price, pressure, austerity, not buying the stuff. 2018 end and 2019, the boom, big double-digit growth, and it went through the economy and everything. Many of our clients in big pharma have said, last year, this year, next year, we can grow 15 to 30% in the federal government essential drug list. But to the pharmacy, to the consumer, we're looking more at 7 to 10%. Remember, good single-digit growth. The second sector would be consumer products generally, but as I said, with a very wide range. So essential household products, big double digits, moderating to high single digits this year. And but general FMCG products, not health related, not detergents and so on, much more high single digits. Some sectors, diapers, children's Pampers and so on, demographics are against you, massive price wars. This would be a very difficult part of consumer products to be in. So consumer products in Russia and, globally, we've got some clients who are plus 50, 60, they are a minority. And we've got some who are still -5, -10. So that's the range. But the cluster, as I've said before, high single digits. This year, quite a lot, double digits, moderating next year. The third and toughest sector was business to business, engineering, equipment, and so on. And that was noticeably in 2019 worse. 2020 start worse. But as we got that recovery at the end of 2020 and now in 2021 and commodities, etc., B2B overall is not bad. And the surveys show this for Central Europe and Russia. And B2B overall, I'm pleasantly surprised the way it's going. And I can see that it's driven by energy sector, which is so important in Russia, automotive sector rallying. Don't get me wrong, I'm not saying easy, but it's certainly rallying better. And then everything to do with commodities. We've heard the mining stories and so on, metals and so on, those parts, and that's a big driver of the Russian economy. And then that flows through to chemicals and sub-supplies into the other sectors as well. So business to business is trending upwards and will trend good, I think, with global trade. And China next year, even at 5%, and the US at 3.5% even next year is good. And Russia, as I said, may be putting more public money into the industrial sector and investment. And that's the flip side, because it needs the public money, because still, to moderate the enthusiasm, it's still in Russia, you know, not enough domestic capital coming into the market, and it's necessary that government money comes in as well. And the worst sectors, of course, obviously, we know, and they're the ones bouncing back now, with the service industry, hotels, hospitalities, restaurants, and so on. Russia was different. The lockdown was not there for more than a year now. And so Russia has been a different story entirely, with a different health development as well. One qualification on Russia, 150,000 fatalities officially, but the excess death rate in Russia is 450 to 500,000. By the way, in India, 400,000 deaths. The belief is the excess death rate is 4 million. So it's not just a Russian story, but, you know, there's been a consequence of not having the lockdowns in place. On this service sector, it's easy to say, well, you know, hotels were massacred and destroyed, and tourism. Not so. We will have several hotel companies in the group, and I would underline their resilience, their survivability. Several hotel chains continued building and investing in 2020. Okay, some of that was ongoing and unavoidable, but in Russia, we have hotel chains investing in Russia in 2020, this year, 2021, and plans for 2022. Not least of which, you know, domestic holidays, Sochi, staycations, and so forth. And Moscow is slowly coming back. Moscow had more domestic business people coming in. But obviously Moscow, the 4-star hotels were really hurt, because they have, the international traveler. And the worst of all, of course, was St. Petersburg service industry, because they did have more tourists and business travelers, and they evaporated, but they are coming back as well. So what I'm saying is, that's the answer to the question. The service industry was the most severely hit. It's coming back strongly now. But of course, tourism, you know, there are still quarantines. There are still, Britain has still amber and red and green countries and so on. Tourism is still well down on pre-COVID rates and will need time. And business travel, Bill Gates said, will be down 50% through until 2022, 2024. And I'm not going to disagree with Bill Gates. Yeah, it feels like that. And just by a personal note, my own business travel has been down 75, 80%. I travel to Moscow next week and in September, and to Britain and to Prague. So my own business travel is picking up, but on an anecdotal basis, I imagine I'm going to be 50% down for a wee while longer. And I think many companies are going to look at the cost impact on that. I'm rambling a little bit. I think, Jonathan, what's interesting from my reply is that, you know, so many sectors did well or survived or proved resilience. That's the conclusion I've come to. Oh, and IT industry, I think I did this very quickly before, also survived pretty well. Domestic home IT, digital games industry, we have companies in that sector who've spoken at our events. Their business is booming. Laptops, PCs have boomed, the accessories and so forth. But also now, corporate spending on digitalization is a story that's never going to go away. So that's good as well. Companies held back on investment, so that was a downside, but they're building up. They want to modernize. They want to be efficient. They want to be digital. And the government story, money is coming in. Of course, on Russia's side, of course, like with other emerging markets in China, you've got the de-globalization of digital. Some of our big IT companies are doing very well in Russia overall, B2B, B2Government, not bad. But some of them face issues with the Russian government, as some face issues with the Chinese government. So that would be a specific as well. Wow. Sorry, long answer to a good question. Oh, lovely. I'd like to withhold my questions. Danny just answered them for me. Good, I'm glad I did. It's good to ramble, isn't it? I can touch everything if I ramble. Anything, Andrea, Nadia, have I missed anything?
Wait? There is a new question,
yeah,
I think. And just for our audience, if you would like to speak, please raise your hand and we will allow you to unmute. Yeah, so you're very welcome to make comments as well. Thank you. Danny, over to you.
Thanks. Hi, Andrea. Your English is fantastic, Andrea. Just this, we will allow you. I'm going to find another verb rather than allow. It makes us sound rather dictatorial. I'm only joking, and I can't think of a better verb at the moment, so don't worry. Danny, could you please comment more on the investment trend in Russia 2021 by the MNCs, all sectors? Yeah, absolutely. Thank you. I think I did before a little bit. Big foreign direct investment by Western companies in Russia is close to an all-time low, and it's going to stay that way for some time. It might creep up now with the geopolitical environment improving, but energy sector and financial with sanctions is so la la. It's happening, but there's a caution to it as well. One executive has famously and rightly said, American company, if I go to my board in the United States of America and say I want a big investment in Russia, they will look at me with peculiar faces and probably fire me. Another executive has been told, US, that, hey, you're doing a very good business in Russia, like many are. You're making profits. Do what the hell you want with your profits, reinvest, and don't wave a flag about it to us. So do it low key, almost under the barrier in an embarrassed way, sort of. Maybe the geopolitical opening that we're seeing, or less tension, more adult relations will help. Sadly, I do think on the longer term and fundamental political ethos, the West and Russia are really mismatched, out of sync, and not close to any resolution or partnership of any kind whatsoever. So I think you're going to get reinvestment. I think you're going to get investment in logistics and warehousing, and there's add-on investment. One of our executives in consumer goods asked me, by the way, 6 weeks ago, same kind of question. Danny, what kind of foreign direct investment is going on in consumer goods in Russia? And I thought to myself, well, nothing. Then I did some research. It wasn't very scientific. I just did some Googling. I checked with some of our group members. And within 2 or 3 hours, I had a list of 15 to 20 investments going on. New production lines. There is a smattering of new factories. One of our canning companies is looking at a new production line and a new factory. I've talked about one of our food and beverage companies looking at a new factory and a new mill. We have another one of the biggest food and beverage investors looking at new production lines, which is already one of the biggest production plants in the world for this US food company. So there are some plus sides on what is publicly a very negative story as well. So I think reinvestment, building up logistics, building up warehousing. Warehousing is hot. Talking about human resources, everybody wants a forklift truck driver. You know, you want your digital expert. Polarization of the HR market. You want digital people, you want great HR directors, great marketing directors. But as I said before, you want blue collar workers, you want road builders, and you want forklift truck drivers in factories as well. So that's the dynamic there. Localization, definitely taking place in the pharma sector. Government is pulling people, but as I said before, companies are looking at their global portfolio. But just to finish off on this, we don't have many companies. I've talked about a couple, but you know, building $100 million detergent plant in Moscow Oblast, you know, those days are gone because the capacity is not needed. The global capacity is not needed. But if companies are looking at tweaking their localization, global supply chains, they might think, hey, we need a mid-size factory in Rostov, don't we? Or we need a food plant closer to Krasnodar. Or we need more production in the Far East to supply growing Chinese, Russian activity, etc. So I think I've answered the question. The public information is bleak, and there's a lot of truth in that, but it does hide some small, mid-scale positive trends as well. Thank you. Oil and gas in Russia. Thank you. In Russia. I think the good news for the Russian economy here, and the oil prices, you know, the money comes into the treasury and budget. That allows more public spending if their choice is there, which is very important, because there's going to be a debate. There is a debate about spending, reducing spending, bringing back austerity, using the sovereign wealth fund, which comes very much from the oil and so on. So this is a big positive for the Russian economy. And what we're seeing already is the OPEC plus deal, which squeezed down production output as planned, is being loosened. So the answer to your question is that Russian oil and gas will start to increase about 1 million barrels per day. It won't increase like this, because then that would impact the price negatively. They're doing the dance between price and volume. You're going to have the shale boys coming back. I thought the oil price would be capped, Brent, capped approximately at 70. So far, I'm not far off. It's, it peaked at 74, I think 72 yesterday, because the American shale producers will come into the market. So the Russians and Saudis will not, massively increase output. And after they had a tragical, farcical price war for a few hours last spring, they've managed this dance and jiggle between volume and price reasonably well. And I think they will continue. And that the answer to your question, if they do continue, is we're going to get more moderate production. The other question hanging out there, of course, is green, environment, climate. And on one level, you could say, I'm not saying it, one could say, there is no future at all for the fossil fuel industry. It's going to die. By the way, it is going to die, for sure. The question is when. Not next week, not next year, 5 years, 10, 15, 20. You know the story. And one of the debates recently we had on one of our webinars was very interesting. Sorry, I'm drifting. Was about Nord Stream, and related to sanctions, of course. It seems that Nord Stream will take place now, but several knowledgeable executives on our webinar said, what the hell is, why is the Germans so fixated on Nord Stream and fossil fuels when that's not the future? Of course, Germany rescinded nuclear energy and therefore painted itself into a fossil fuel corner, and maybe painted itself into a Russian supply corner, hence the enthusiasm for that. Quick one, that takes me to sanctions, which I haven't mentioned. I think I've got sanctions broadly right. Probably everything changes tomorrow, but for a couple of years I've got it right. I said that they're not going away. The US ones will never go away, but I don't think US sanctions will be particularly impactful going forward. And the set of sanctions in April, as a clear indicator, were very mild and moderate and had no impact. The Europeans and Germans are loath to increase sanctions on Russia and do not want to do so. The Poles and the Balts do want to do so. Germany does not. France doesn't really, neither does Italy. But Germany will dictate this. We'll see what happens if the Greens come into a coalition government in Germany after September. But otherwise, I think the sanctions threat is was very limited and actually remains very limited. And we're seeing this positive geopolitical sanctions perception on the ruble already. And that's part of my story moving forward. Pharmaceuticals in Ukraine and potential growth in the state-funded programs, yes. Ukraine, no disrespect to our CIS and non-CIS former Soviet republics, because the Ukraine market is doing well. Real wages have been very strong, even stronger than in Russia. The currency has stabilized. Inflation has picked up, of course, like everywhere, and it's closer to 9–10% in Ukraine at the moment. But again, we think that will be on a declining trend going forward. I think the currency also had a wobble with COVID, might have small depreciation, 1%, 2%, 3%, but the consensus view is currency stability. So a lot of that is good news for consumption and the Ukrainian economy, and we're quite upbeat on it. On the pharma side, yes, it's also been doing well. You know, the focus has been there, the spending has been there, and the consumer, like in Russia, wanted to look after their health. If they had disposable income, they would spend on it. The numbers have not been comparable with Russia because Russia brought in the national projects end of 2018, 2019. Russia was compensating for several years of deep austerity by the government. Ukraine is more flat in a way, rather than the volatility of Russia, down with austerity, up with the national projects. It's a more stable, less exciting, less bouncy pharmaceutical environment. But to your point, I think that there is potential growth and upside from state funding. I think the IMF, we've got the temporary dispute, which is always there with the IMF negotiations. Ukraine does need to do more on corruption, central bank and so forth, of course, but massively challenging requirements. And I think they're doing a reasonable job in the circumstances. But of course, we and anybody can think they can do better, and it would be good if they could. So what I'm saying is the IMF money will be in place. There'll be enough support for the economy, and therefore the government would have money for the actual state-funded potential to take place in reality. I do think, just one point here, I do think the Nord Stream conclusion, and then the idea of tossing Ukraine $500 million or $1 billion for green development, certainly if I was president or a Ukrainian, I would feel let down by that arrangement, which is a vague bag of promises of support in some vague circumstances. That's geopolitics at the moment. Why? I know why Merkel did it, but why did Biden do it? One argument, and one could understand this, is President Biden in the US is so focused on China. The foreign policy priority of China was of the US was described as 3 priorities: China, China, and the third priority is China. And the point I'm making here is there's a view that the US is trying to clear the decks with Russia, park Russia as a non-problem, and then spend the next 10 years discussing, arguing, and fighting verbally and trade-wise, not war-wise, with China. And I think we're seeing some of that. God, I do ramble when I get going. Right, here we are. That's the pharmaceuticals. You've got the sanctions well. Would you comment also on the resolution of the Rita? Thank you. Yeah, I did get sanctions well, and I got ruble pretty well, Donetsk region and Crimea. If you take the mid-long-term view, it's very difficult to see how any Russian president can, give back Crimea now. We know the history of Crimea, Khrushchev, 400 years ago, etc. I know it very well, and I think most people on this call know it very well. I think on Crimea, with some goodwill from the Russians and the Ukrainians, with some goodwill, which we don't have at the moment, there could be a form of words about sovereignty on Crimea. You can find a way to do it. And if you've got a strong and popular president in Russia, he could push it through. And you would need the same in Ukraine, by the way. They would say we have joint sovereignty for the next 1,000 years, and you would put some vague terminology in there. It can be done. Donetsk and Eastern Ukraine is much more problematic, and it's a cancer. It does great harm to Ukraine, but as I've said for many years now, it does great harm to Russia. It's caught the whole adventure, including Crimea, has cost the Russian economy and the Russian people 25, 40, 50 billion dollars and rising every year, plus the emotional, moral, political cost and the alienation of Ukraine and Russia. These are the other costs as well. As with Moldova, Transnistria, Abkhazia, and other places, they're not statelets, but these enclaves tend to be centers for corruption, smuggling, counterfeiting, prostitution, whatever. And it personally, to me, everybody knows on this call that I am Russophile, Ukraine-phile, and want the best for the people. And these adventurist enclaves do no good to anybody. Untangling them should be easier than Crimea. But that would involve an even bigger pullback for Russia to say, we let these hang in the wind. Again, though, I think some form of words could be, with goodwill, some form of words. I think they need to be under the authority and control, of course, of Ukraine, but some form of words, not the federalization of the Ukrainian state, but some form of words could be found even on that. And I think really for Russian interests, I know we all know why they're there, but I think for Russian interests, it's not worth the salt, and it would be in the better interests of Russia to be out of there, to find a form of words on Crimea, and then to engage in trade and better relations, etc. That's the win-win. And to answer your question, Rita, I think in the short term, it's not going to happen at all. And at best, it's somewhere out in the midterm, 50-50. Thank you for the question. Sorry for the vague and not positive answer. Looking at, oh, great presentation as always. Thank you, Lydia. You and my mother. Great. No open questions. That was great, though. I'm waiting for anybody, but we're at the hour and a half. I've got time. I think we're closing out there. Really loved it. Thanks for the questions. I'm glad it worked so well. Please, for those of you who remain, the hardcore, just for the third time, if you need anything in-house, 30 minutes, 1 hour, 2 hours, a lot more focused, of course, I'll be very happy to do that. If you have any other questions, let us know. And I just remind you, you do know, we have live meetings in Russia, a small one on the 19th of August, the bigger one at the Atrium Kempinski on the 17th of September. This information has been sent out. If you need a reminder on that, the link, let us know and we'll send it to you. Otherwise, everybody, thanks to my team. Oh, thank you. And thank you to my team, and thank you to all of you. Once again, third time, thanks for the great questions. Really enjoyed it. Felt very interactive. Have a great day, and have a great end of the year, and enjoy doing your budgets. All the best.